Hi, welcome to our video, and in this video we're going to talk about whether the Fed will be forced to cut interest rates. The Federal Reserve is currently in a difficult position. On the one hand, inflation is running at a 40-year high, and the Fed has a mandate to keep inflation under control. On the other hand, the economy is slowing down, and there are concerns that a recession could be on the horizon. If the Fed raises interest rates too much, it could risk tipping the economy into a recession. But if the Fed doesn't raise interest rates enough, inflation could spiral out of control. So what is the Fed going to do? It's too early to say for sure, but there are a few different scenarios that could play out. One possibility is that the Fed will continue to raise interest rates, even if it means risking a recession. This would be a risky move, but it would send a strong signal to markets that the Fed is serious about fighting inflation. The Fed has already raised interest rates several times in an effort to cool inflation. If inflation continues to rise, the Fed may feel that it has no choice but to continue raising rates, even if it means risking a recession. This would be a risky move, as it could lead to a sharp slowdown in economic growth and even a recession. The Fed's decision on whether to continue raising rates will be based on a number of factors, including the pace of inflation, the strength of the economy, and the actions of other central banks. However, one of the most important factors will be the Fed's desire to send a strong signal to markets that it is serious about fighting inflation. The potential consequences of continued rate hikes are significant. If the Fed raises rates too much, it could lead to a sharp slowdown in economic growth and even a recession. This would have a negative impact on businesses, consumers, and the stock market. This will be a delicate balancing act, and the Fed's decision on whether to continue raising rates will have a major impact on the economy. Another possibility is that the Fed will pause its rate hikes and wait to see how the economy evolves. This would be a more cautious approach, but it would also give the Fed more flexibility to respond to changing economic conditions. The Fed has already raised interest rates several times in an effort to cool inflation. However, if inflation starts to fall, the Fed may decide to pause its rate hikes and wait to see how the economy evolves. This would be a more cautious approach, as it would give the Fed more time to assess the situation and make sure that it is not overreacting to short-term fluctuations in inflation. Pausing rate hikes would also give the Fed more flexibility to respond to changing economic conditions. If the economy starts to slow down, the Fed could still cut rates if necessary. However, if inflation starts to rise again, the Fed could also resume rate hikes if necessary. There are some risks associated with pausing rate hikes. If inflation continues to rise, the Fed may be forced to raise rates later, which could lead to a sharper slowdown in economic growth. However, if inflation starts to fall, pausing rate hikes could give the economy a chance to catch its breath and avoid a recession. It's also possible that the Fed will be forced to cut interest rates in 2024. This would be a sign that the Fed has lost control of inflation, and it would likely lead to a recession. A cut in interest rates would make it cheaper for businesses to borrow money and invest, which could boost economic growth in the short term. However, it would also make it more difficult for the Fed to cool inflation in the long term. A recession is a period of economic decline characterized by falling output, employment, and incomes. A recession is typically caused by a combination of factors, such as a decline in demand, an increase in supply, or a financial crisis. A recession can have a significant impact on the economy, leading to job losses, business closures, and a decline in living standards. The Fed is facing a difficult decision, and the consequences of its actions could be far-reaching. Ultimately, the decision of whether to cut interest rates in 2024 will be a difficult one for the Fed. There are no easy answers. However, the Fed will need to make a decision soon, as the economy is already starting to show signs of slowing down. Overall, the impact of a Fed rate cut in 2024 would be complex and far-reaching. It would likely have both positive and negative effects on the economy, and the ultimate impact would depend on a number of factors. However, it is clear that the Fed's decision on whether to cut rates in 2024 would be a significant one with the potential to have a major impact on the economy. Thanks for watching, and I will see you in the next video.